October 29th, 1929. Black Tuesday, the day the stock market collapsed and triggered the Great Depression. 13 million Americans lost their jobs. 5,000 banks failed. Fortunes built over generations evaporated in hours. The official story? Irrational exuberance. Market speculation? A correction nobody saw coming. But what if I told you that's not the whole story? What if the crash wasn't an accident, but was deliberately engineered by the very people who profited from it? What if documents and testimony show that Wall Street insiders knew exactly what was coming and positioned themselves to benefit while millions suffered? This isn't just a theory. This is documented history that has been buried, sanitized, and removed from the textbooks. Before we dive in, let me know where you're watching from. Drop your country in the comments. And if you're ready for the financial history they don't want you to know, hit that subscribe button. What I'm about to show you will change how you see every market crash since 1929. Let's start with a question few want to answer. How did some of America's wealthiest families get richer during the Great Depression while everyone else was wiped out? The year is 1929. America is booming. The roaring 20s, jazz clubs, speakeasies, and a stock market that only seems to go up. Between 1924 and 1929, the Dow Jones soared 400%. Ordinary people were taking out loans to buy stocks. Everyone believed the party would never end. But some people knew better. People with the power to decide when it would happen. In the spring of 1929, months before the crash, something strange started happening. Wealthy insiders began quietly selling their stocks, converting them into cash and gold. Joseph Kennedy, father of the future president, sold his entire portfolio. The story goes, he knew it was time to get out when he got a stock tip from a shoeshine boy. A nice story, but the truth is more calculated. Kennedy had deep connections to major banks. The Rockefeller family also quietly reduced their stock exposure. Bernard Baruch, a Wall Street titan, sold his stocks and bought gold. What did they all have in common? They were connected to the small group of banks that controlled the nation's money supply. Let me explain how this worked, because the mechanism is key. In the 1920s, speculation was fueled by margin loans. You could buy stocks with just 10% down, borrowing the rest. This is buying on margin. As long as prices rose, you made a fortune. But if prices fell, it was catastrophic. The bank would issue a margin call, demanding you repay the loan immediately. If you couldn't, they'd sell your stock, driving prices down further and triggering a domino effect of forced selling. The system was a time bomb, and the banks held the detonator. How? Because banks control credit. If they suddenly restrict lending and call in loans, the whole house of cards collapses. And that's exactly what happened in the fall of 1929. Major banks began tightening credit. They raised interest rates on margin loans. The public was told this was just responsible banking. But the timing was too perfect, too coordinated, and too beneficial to the insiders who saw it coming. On October 24th, 1929, Black Thursday, the market plunged. Panic selling erupted. Margin calls cascaded. Then, a group of powerful bankers from J.P. Morgan, Chase, and National City Bank met. They announced they would pool their resources to stabilize the market. The newspapers hailed them as heroes. But here's what the history books don't mention. While these bankers were publicly buying stocks to restore confidence, they were secretly selling their own holdings. Albert Wiggin, the CEO of Chase Bank, made millions by shorting his own company's stock, betting it would fall. These weren't just a few bad apples. It was systemic. By Black Tuesday, October 29th, the market was in freefall. By 1932, the market had lost 89% of its value. 13 million people were jobless. 5,000 banks failed. But the wealth didn't just disappear, it was transferred. When you're forced to sell your assets for pennies on the dollar, someone is buying them for pennies on the dollar. And who was buying at the bottom? The same people who sold at the top. Joseph Kennedy and the Rockefellers used the Depression to buy up stocks, businesses, and real estate at bargain prices, dramatically increasing their fortunes. The pattern is clear. Create a bubble, sell at the peak, trigger the crash, and then buy everything back at the bottom. But was it intentional? The evidence comes from the Pecora Commission, a 1932 congressional investigation. It uncovered damning proof. National City Bank and J.P. Morgan had secret preferred lists for politicians and judges, offering them stocks at a discount, essentially legal bribes to ensure they would never be regulated. The commission found that banks deliberately tightened credit in 1929, knowing it would trigger the crash, all while positioning themselves to profit. The evidence was entered into the public record, and then it was buried. But the story gets even more disturbing when you look at the Federal Reserve. Created in 1913 to provide stability, the Fed did the exact opposite. Throughout the 1920s, it kept interest rates artificially low, fueling the speculative bubble. The head of the New York Fed, Benjamin Strong, had deep ties to J.P. Morgan. The Fed wasn't serving the public, it was serving Wall Street. Then, in 1929, the Fed started raising rates, lighting the fuse on the time bomb it had created. When the crash came, instead of providing liquidity to save the economy, the Fed tightened the money supply even further, turning a recession into the Great Depression. Why? Because the Federal Reserve isn't a government agency. It's a private institution owned by member banks. The same banks that profited from the crash were the ones controlling the Fed's policies. They created the bubble, then popped it to consolidate their power. This was a controlled demolition, and the Fed was the crew. The Bank of England, led by a close friend of Wall Street bankers, even coordinated its own rate hikes to help choke off the credit supply. Now, you might be thinking this is all ancient history, but has anything really changed? Look at the 2008 financial crisis. The pattern is identical. The Fed kept interest rates low, fueling a massive housing bubble. Banks used extreme leverage and sold toxic mortgage products they knew were shitty deals, all while betting against them. Insiders knew a crash was coming. They got rich, the public got bailed out, and the same banks became even bigger and more powerful. The game hasn't changed, it's just gotten more sophisticated. The story of 1929 isn't just about a stock market crash. It's a warning about how power and wealth are truly accumulated and how the financial system can be weaponized against the public. Remember the 2008 crash? It wasn't just a market correction. It was a massive consolidation of power. The biggest banks swallowed their competitors, growing even larger, just like they did after 1929. And the architects of this meltdown? They didn't just walk away, they walked away richer. Dick Fuld, the CEO of Lehman Brothers, pocketed nearly $500 million before his bank imploded, leaving 25,000 people jobless. He was never prosecuted and still lives in a mansion. Lloyd Blankfein of Goldman Sachs took home $150 million while his bank got a taxpayer bailout, famously calling his work God's work. Angelo Mazzillo from Countrywide Financial paid a fine for insider trading, but kept the bulk of his $140 million fortune. Jamie Dimon at J.P. Morgan was hailed as a hero for buying up failing banks, but his own company was neck-deep in the very practices that caused the crisis. Not one of them faced real consequences. Why? Because the system is designed to protect its own. The banks are too big to fail, too connected to prosecute. This isn't a bug, it's a feature. So, how do they pull this off? Legally, time and time again. It's called the boom-bust cycle, and it's hardwired into our financial system. Here's the playbook. First, the Fed drops interest rates, making money cheap and easy to borrow. This sparks a boom. Asset prices, stocks, real estate soar. Everyone feels like a genius, but this boom is built on a mountain of debt, not real value. Eventually, that debt becomes too heavy. That's the cue for the Fed to hike interest rates. Suddenly, borrowing is expensive. Defaults skyrocket and the whole house of cards comes crashing down. This is the bust. And during this chaos, the insiders who sold at the top, now sitting on piles of cash, swoop in. They buy up valuable assets, businesses, properties, entire companies, for pennies on the dollar. Then, the cycle resets. The Fed lowers rates again, and the whole process starts over, making them even richer. Think this is a one-off. Look at the history. 1929. 1973, 1987, 2000, 2008, 2020. Each crash is given a different name: speculation, oil prices, dot-com bubble, subprime mortgages, a pandemic. But the underlying mechanism is identical. Easy money inflates the bubble, tight credit pops it, insiders profit from the chaos, and the public gets left holding the bag. You're told to buy and hold for the long term, which really means you have rue the one forced to sell at the bottom when you lose your job or get a margin call. You are the source of their wealth transfer. This isn't capitalism. It's a rigged game where the house always wins because it sets the rules. Now let's look at today. The warning signs are flashing red. Since 2020, the Fed has printed trillions of dollars, more than in the entire previous century. This ignited an everything bubble. Stocks hit all-time highs during a global crisis. Housing prices went vertical, and crypto went to the moon. But what happened in 2022 and 2023? The Fed slammed on the brakes, launching the most aggressive interest rate hikes in 40 years. Sound familiar?